Kapil is supposed to get married in around a month's time. Due to a sudden shortage of funds, he decides to borrow, but gets bewildered by so many types of loans out there in the market. There are so many types of loans in the market. These can be categorized as secured loans and unsecured loans. So, moving back to Kapil's case. The gold loan, where he would have to keep some gold with the bank as security, is a secured loan, and gold to be kept as security is called a collateral. Now, if he fails to repay the loan, the bank can sell that asset, gold in this case, and recover the money. Since these loans are secured by some collateral, they charge lower interest rates and can be availed by people with poor credit score as well. Very quickly, credit score is a number which tells the lender about the credit behavior of the borrower. Basically, it shows the creditworthiness of the borrower. So, Kapil's other borrowing option, wedding loan, is an unsecured loan where no collateral is required. These loans usually charge a higher interest rate as compared to secured loans. Now let's see different loans that fall under both the categories. Home loans, vehicle loans, gold loans are some of the most popular secured loans. We'll start with a home loan. A home loan is a big ticket size secured loan which is taken for buying or constructing a home. In this loan, the home itself is the security for the bank. These are very long-term loans of say 10 years, 15 years, 25 years or even longer. Banks usually lend up to 80% of the property value, meaning a property worth 1 crore rupees can get you a loan of up to 80 lakh from the bank. Next is auto loan. These loans are taken to buy a new or used car, bike or any other vehicle. The vehicle itself is the security for the bank. These loans are usually paid back over a period of 3 to 7 years in EMIs. If the borrower fails to repay the loan, the bank can seize the vehicle. Next, let's move to gold loan. So, as the name suggests, gold loans are taken against the gold. The lender or the bank will keep your gold as security and give you money against it. You may get up to 90% of the gold value as a loan. Generally, you may take a gold loan for a maximum up to 5 years. Gold loans are popular as you can pay only the interest in EMIs and repay the loan amount in full at maturity. Next, we have loan against property. So, in this loan, the borrower can keep his house or any commercial property as security with the bank and avail funds. You can get around 65 to 70% of the property value as a loan. Next is loan against securities. If you have invested in shares of any company, bonds or mutual funds, you have an option to go for a loan against these securities. So, you can keep those shares as collateral with the bank or other financial institution for the loan. You can get around 50% of the value of shares as a loan. Another type of secured loans are title loans. In title loans, you can borrow by keeping your vehicle or home or land as security with the lender. Under these loans, the title, which means the ownership of the asset, is temporarily transferred to the lender. These are very short-term loans of say 30 days. Once you repay the loan, the ownership is transferred back to you. They usually charge a very high interest rate of around 300% per year. Unsecured loans are the ones where the borrower need not keep any asset with the lender as collateral. So the most popular unsecured loan is a personal loan. In case of personal loan, you are not required to keep any security with the bank. You can use the money for any purpose, be it medical emergencies, traveling, and so on. The amount of loan will depend on your income and credit score. If your credit score is bad, bank may refuse to lend to you. Wedding loans, travel loans, home renovation loans, education loans, and pension loans are all personal loans. Next, we move on to the most happening loan type, instant loans. These are small and quick loans which can be availed when there is an urgent need of money. Instant loans are also a type of personal loan. Let's move on to another unsecured loans, short-term business loan. If a business faces a financial crunch, they can go for short-term business loans. Next, let's move to credit cards. So, credit cards, as we all know, are used to make payments without spending actual money. But you have to repay within specified time to avoid late payment charges. If the user fails to pay the dues on time, he'll have to pay a high interest rate. By now, you must have a clear idea of different types of loans. With this, we have come to the end of this video.